In this video, we're going to look at how GDP captures economic activity, how it is defined, and how it can be used to compare economic performance across countries and over time. Now, GDP is one of the many measures of economic activities that we could calculate. We could focus on variables like employment or capacity utilization. But typically what we do is we focus on variables that capture the economic value of what is created in a country in a given period of time. And those are values that look like expenditures, income, production, or sales. Well, it happens to be that GDP is the most common measure of the monetary value of economic activity, and it's going to capture all the economic activity that happens within the borders of an economy. Now, to see how all these variables are linked, production, income, or expenditures, we can represent very simply what we call the flow of income within a country. Now, companies will produce, and the value of that production is what we will call the GDP, but that production has to go somewhere. It has to go to sales that feed into the income of someone. Now, if we tracked every transaction properly, the income of a country will also be identical to the GDP. In addition, the sales must have some customers behind doing expenditures that, once again, if we capture those expenditures properly, should be identical to the GDP of a country. Now, what we do as well is to look at components of each of these variables. For example, when it comes to income, we're going to talk about the income of companies as the profits. When we look at the income of households, we're going to talk about wages. And when we look at the income of the government, we're going to talk about taxes. Now, each of these incomes are going to be matched by some form of expenditure, which is also going to be attached to each of these economic agents. So companies will invest, households will consume, and government will do government spending. Now, a more formal definition of GDP is that it will measure production of an economy in a given period of time, which means this is a flow, it's not a stock measure. And how do we measure that production? By using market values. Now, in practice, what that means is we're going to value all the quantities produced in the economy using the prices that are paid by either households or companies or the government. Now, there's many technicalities when it comes to the measure of GDP. One that is important to highlight is that one has to be careful and not double count any of the values. In particular, some of the companies will produce intermediate input materials that will feed into the production process of other companies. Now, we want to avoid that double counting by either only including the production of final goods, so we do not include the production of anything that looks like an intermediate input, or alternative, we include the production of everything, but rather than adding the total value or the revenue of the company, we're going to include only the value added of each of these companies. Now, in practice, that means that we're going to look at the revenues minus the cost of intermediate inputs. That's going to be the definition of value added. And if we add all the value added across all companies or sectors, we're going to get the GDP. Now, let's start using GDP to think about performance across countries. Let's start with a very simple example. We measure GDP in two countries, let's say in 2014, and we're going to look at the US and France. Now, in practice, what we're doing is looking at the quantities produced in the US, the quantities produced in France, and valuing them, those quantities, using the prices in each of these countries. Now, the final number cannot be compared, because in one case it's going to come in US dollars, the other is going to come in euros. Now, to do a comparison, to talk about relative economic performance, we need to convert those prices into some common units. Two things we can do. One that is very simple is to say, let's take the dollars, convert them into euros by using the exchange rate, the market exchange rate between the dollar and the euros. Once I do that, the US number is going to be expressed in euros now, and I can do a very quick comparison between the two figures. Now, there's an alternative, which in some cases is going to produce a more meaningful number, which is to say, let's not use market exchange rates because they might give us possibly a distorted view of the world. Let's use what we're going to call international prices. Now, in practice, what this means is that when we value the quantities produced in the US or the quantities produced in France, we're going to use prices, which we call international prices, which are going to be identical in both countries. In other words, we're valuing the production in the US and France using the same prices, therefore the same units, and we can easily compare these two magnitudes. Now, this approach is what is called purchasing power parity and is very commonly used to compare magnitudes, macroeconomic magnitudes across countries. Now, how do we compare performance of a single country over time? So this is the challenge that we have now. We have GDP numbers for 2 years, same country, but 2 years, let's say 2013, 2014. Now, these numbers will be expressed in value using the prices of the year that they correspond to. Now, the way we're going to refer to this GDP, we're going to call it the nominal GDP. Whenever we use current prices, prices of the same year, we have the nominal GDP for that year. So we do that for 2013, 2014, and what we notice is that we have the same problem as when we were comparing GDP across countries. We have units which are not the same in both lines. In one case, we're using prices of 2013, in the other 2014. From a practical point of view, it means that if we want to compare these numbers, we don't know whether the difference is going to come from prices or quantities. Now, typically, what is it that we want to compare? We want to compare quantities. How do we do that? By fixing prices. So we're going to calculate a different measure of GDP that we're going to call real GDP by using prices in a base year. Now, from a practical point of view, what we will do is we will keep the quantities the same as before. We'll have the quantities in 2013 and 2014, but now we're going to use these identical prices in a base year, let's say 2000, to compute the value of those quantities. That says that whatever variation we see between 2013 and 2014 is entirely due to changes in quantity. Now, that's a much more accurate measure of economic activity because it hides the changes in prices. Now, one way to summarize this is to bring the concept of inflation into the analysis. What is inflation? Inflation is the change in the price level, in the price index of a country. Now, what are we doing when we look at real GDP? What we're doing is decomposing the total change in GDP, which is the change in nominal GDP, into two components. One, what we call real GDP, which is going to be the change in quantities, and the other is going to be inflation, which is the change in prices.